Hello, my name is Tony Bernardo. I'm a professor of finance at the UCLA Anderson School. I'm here today with Feifei Li, one of our PhD students in finance. Feifei did her dissertation on the topic of mergers and acquisitions. This is a very interesting topic. In 1999, for example, there were over $1 trillion of M&A transactions in the U.S. alone. And one of the things we do know about M&A transactions is that they tend not to work so well in the long run. And Feifei's research helps us understand why. So Feifei, maybe you'd like to tell us a little bit about why you think M&A transactions don't always work out so well for shareholders.
Okay. One possible explanation is those acquiring firm CEO always have private information about the fundamental value of their shares. So they always know whether the market has a fair estimate of their share value. If they see their shares are overvalued by the stock market, they tend to use their shares as a cheap currency to take over another company.
So an example of this might be AOL Time Warner, where you might conclude that American Online recognized that their shares were overvalued and they decided to use that currency to acquire valuable assets of Time Warner.
Yes, exactly. That's a good example. So in the long run, the acquiring firm's stock will collapse because before the acquisition, ex ante, their shares are already overvalued by the market.
So this is very important because what you're saying is that the merger and acquisition activity per se is not diminishing the value of the acquiring company. It's that these acquiring companies were overvalued in the first place.
Yes.
So from a managerial perspective, what can we learn from this kind of knowledge?
So from the perspective of the target manager, we should always incorporate when the acquiring firm is trying to use their shares. It's a signal of the overvaluation of their shares. So when we try to evaluate the transaction by the market value of their shares, it could be an overestimate.
One of the interesting things you do in your dissertation is to look at private targets. How can you conclude that misvaluation is driving these acquisitions when there are other reasonable hypotheses? For example, perhaps owners of these privately held firms would like to cash out of their position and perhaps are looking for an acquirer to do that. What makes you think it's misvaluation that's really driving most of merger and acquisition activity?
One important part of my paper was studying the relative size of the transaction. So for those relatively small acquisitions, when the transaction value is actually smaller than 10% of the acquiring firm's market value, those acquiring firms still underperform 12% over 3 years after the deals are completed.
So that's very interesting. So essentially what you're saying is if a firm acquires a private firm for, let's say, $100 million, but its market value drops by more than $100 million, there must be some information that we're learning about the acquiring firm that suggests that perhaps misvaluation is driving the merger and acquisition as opposed to, let's say, some clash of corporate cultures which is destroying value.